Are the highs and lows of the day the same? Are they formed in the same way? Do they have the same strength? How should I trade them? When should I wait for a confirmation? Or when can I trade the touch at the high or low of the day without confirmation? And when is it likely going to break? Hi everyone, I'm Pedro, and today we are going to answer all these questions and learn how to trade the high and low of the day. So, are all the highs and lows of the day the same? We have two types of days. So let's look at type number 1, trending days. Let's say that this is the start of the day and then the price starts moving. In this example, it's making an uptrend. So we have the low of the day somewhere here. But since we are on an uptrend for the day, every high that the price makes, it will tend to be broken very easily. So these are not the kind of highs of the day that we want to trade. On the other hand, this low of the day that it's here, since the price went very far away from it and the low is not very recent, it started here, so a lot of time passed since the low of the day was created, different than here, since the high of the day is constantly being created, a new one. If at some point the price starts coming down and hit this low of the day, this is where we will tend to have some kind of reaction that we can trade. The same example, if we are on a downtrend for the day, we should ignore the lower lows, the new lows of the day that are constantly being created, but the high of the day may have some resistance there. And if the price turns and goes back there in the future, we had some distance from the high, a lot of time has passed since the high was created. Here the price will tend to have some kind of reaction that we can trade. And then we have the second type of the day, a day where the price is, let's say, ranging. We can start somewhere like this, and the price is somewhere in the middle. We have a low of the day here, and we have a high of the day here. When the price comes back to these levels, after passing some time and after being far away from the point where the high of the day was printed, when the price goes back there, this is where some kind of reaction should be expected. Or if it goes to the low of the day, it's the same. At this point, we should expect some kind of reaction. But remember, we need time after the low of the day was created, and ideally we also want the price to go far away from the low, and then the comeback, that's when we want to trade this touch. Now let's learn what we need to look for when the price touches these key zones, because that will tell us if we need to wait for some kind of confirmation before trading the reversal, or if we can trade exactly at the touch without waiting for any kind of confirmation, or if the price is actually more likely to break the high or low of the day. So here we have an example. This is DAX, this is the 1 minute time frame. And here it was the low of the day. It was printed here. The high of the day was somewhere at the top. The price didn't get there, so it doesn't matter for this example. And now look what happened. The price printed this low of the day. It made a move to the upside, and then it came to the low of the day again. After some time has passed, and after it had some distance from the low of the day. And this is the typical scenario where we want to wait for some kind of confirmation. And what's the confirmation? It's rejection from the low of the day. And how do we know that the price is rejecting the low of the day? One of the things that appear are these wicks here at the bottom. When the price prints wicks at the bottom after a down move like this and hitting a support, which is the low of the day, the break of the top of this candle can be a good opportunity to go long. And here I like to use a moving average to place my targets. So since we have this is my 20 moving average here, simple moving average. it's on a downtrend, it's pointing to the downside. So the price can still hit this 20 moving average and then go back down again. So I would use this 20 moving average as a target, a possible target for my long trade that I would take right here from the bottom. Now let's update the chart. Since we have a new support that was printed down there, we can delete the previous low of the day. And now look what happened. After this touch here, this move, it felt this support, the price made a move to the upside, and then it came back to the support, to the low of the day again. Some time has passed, the price had some distance from the touch at the low of the day, and here we have another kind of reaction. It's different than this because it doesn't have as many wicks, or the wicks are not as big as this first touch, but we have a different kind of reaction. We have some kind of engulfing here. We have a red candle that touches the low of the day, the new low of the day, and that it's immediately deleted by a green candle. And the break of the high of this red candle can be a good trading opportunity for me to go long. But here I can have a different target. And why? Look at the moving average. Here we had a moving average that was pointing to the downside. And here we have some kind of sideways move on the moving average. It had some slope there, some move there, but it's kind of sideways. And when the 20 moving average is more or less horizontal like this, the price will tend to go from one side to the other, one side to the other, one side to the other. So we can actually use a target on the other side of the moving average, considering that the moving average is kind of flat and that it will break it to the other side. The price is ranging, is not trending, because when the price is trending, is above the moving average, it will make moves up and down respecting the moving average. And guys, look at this. I actually took a trade here. This was my trade of the day, following the trend. I saw this wicked candle here, rejecting moving averages on the downside. I went long when this wicked candle was about to be broken to the upside. I anticipated my entry a little bit and I took my profits above this high. Actually, my profit take was around there, but the price came back very fast. I was trailing my trade and the price came down very fast and I had some slippage, but I still got some 10 points here. And this was my trade of the day at the open of the London session. It was kind of 6 or 7 minutes after the London open and I was done for the day. And guys, if you want to know more about how I trade and how I take these trend trades, you can check the 6-day free trading course that I have. There's a link in the description of this video. Now, getting back again to the same example, we have a third touch at the low of the day. And what did the price do? Exactly the same thing that did on the previous touches. It went away from the low of the day. We had some decent distance. We had some time before the touch. And when the price touched the low of the day, it rejected. And the break of this red candle here could be a good opportunity to go long. Or we had another immediate pullback after that, printing another red candle with a wick at the bottom. And the break of the top of that red candle could be another good opportunity to go long. And here I would probably target the 20 moving average because now it was sloping down again. So I wouldn't extend my take profit to the other side of the moving average. But there was enough distance for a decent profit. So here it could be a good place to target to close your trades. Guys, and now look at what happened after the third touch. This was the first touch, this was the second touch, and this was the third touch. And at the fourth touch, the price broke. And how can I tell here that the price would more likely break the low of the day instead of rejecting like it was rejecting previously? Look at the price action. When we had this drop here, the price started to print some wicks at the bottom of the candles. It still went to the low of the day, and that's where it rejected. When it made this drop here, it printed some wicks at the bottom of the candles. It still went to the low of the day and rejected. when it made this drop here, it printed wicks here in the middle. It still went to the low of the day and rejected. But here is different. The price is going down. Instead of printing wicks below the candles, it printed wicks on the top of the candle. So the price tried to go up, but it was immediately rejected to the downside. And here is a good opportunity to short, guys. You see these two pin bars with wicks at the top? The bottom of these candles could be a good short opportunity to anticipate the break of the low of the day. We still could have a reaction here, so if the price reacted and came back to us very quickly, we could close our trade at break even, for example. But this was telling me that the low of the day would probably not hold this time. There was not reactions to the upside, and when the price tried to go up, it actually printed some wicks at the top. Then it broke, and then you can use the trend trading strategy that I teach on my other videos to ride this trend to the downside. So here the price was ranging, and here it started trending. So you can use pullbacks to trade this downtrend. And now let's look at the third example, and this is when we can trade the touch immediately without waiting for confirmation. So guys, the price was coming here, and this line was the previous low of the day that was printed previously. So we have here the first touch that we could trade waiting for a confirmation, and the break of this red candle could be a good opportunity to go long. And then the price made this big move to the high of the day. This was the high of the day that was printed already previously before this price action here. And look how the price reached the high of the day. It started printing green candle, green candle, green candle, and then it made this huge green candle that went to the high of the day at once. Guys, this candle, when it touched that high of the day, it was like this. This is massive green. And when we see consecutive green candles and then a huge green candle that like this is what we call an exhaustion. The size of this green candle, it's almost like half of the range of the day. If we split the range of the day in two, the size of this green candle was almost half of the range of the day. And when you see the price touching the high of the day like this is when you can hit your sell button and expect some kind of reaction, big reaction to the downside. So guys, if you are watching this video so far, it means that you liked it, so don't forget to hit that like button. If you are new to the channel and like the way that I teach, consider subscribing and activating the notifications button. Stay away from trouble, and I see you again on my next video.